Okay, so that's it. So I talked about administrative overheads, not related to bringing inventory to the condition. For example, now you are charging like marketing costs, eh? Charging advertising, charging internet costs, which inventory does not require internet to produce it. Only the inventory require internet. Does not require internet, does not require marketing costs, does not require advertising costs, does not require ink cost, printer costs. You are bringing those costs in as inventory. They are not costs to be included. Also, selling costs, like I talked about, they should not be included because those do not form part of a cost for inventory. So those costs should not be included. So I've given an example here which says a company manufactures. Please, I want you to pay attention to what I'm teaching because I have loads of questions to ask you today on inventory, and I want you guys to get the answer. So I want you to pay attention very well to all of these things. As I'm giving you simple examples now, I have loaded examples that you're going to be answering, question and answers for you on inventory. So a company manufactures. Okay, I'm taking a break now after this one. Let me just use an example. A company manufactures t-shirts. T-shirts, right? So fabric is £5, buttons is £1, labor is £3, and then factory rent is £2. You have to include it as your cost of inventory because for that t-shirt they produce, obviously that t-shirt will use fabric, right? Buttons, they will use button for that t-shirt. Then they will need labor to sew that t-shirt. Then they will need to pay rent for that shop. The shop rent might be £20 a month, and £2 might relate to that production. If they broke it down, then it needs to be included. However, sales commission is £1. Advertising cost is £1. You cannot include them as inventory, so you have to exclude them from inventory. I don't know if that's clear. Okay. All right. So please, I want to take a little break for 15 minutes. We'll be back at 40. That's not even 15 minutes, like that's about this thing. Um we'll be back at 7:48, yes, please. So right. Okay, all right. I'll be right back. Thank you. Hello, everyone. Back. If you are in the class, please give me a thumbs up. Thank you. Give me a thumbs up if you're in the class. Please give me a thumbs up if you're in the class. I know you're in the class. Thank you very much, sir. Thank you very much, ma. Mr. Opele, Mr. Mo, if I don't think he's in the class. Thank you, ma. Mr. Mo, if he's not in the class. All right, so that's cost not included. All right, so I'm going to move to the next thing, which is a question. So, is storage cost before sales included in inventory, Mr. Opele? Is storage cost before sale included in inventory cost? Question and answer on this, Mr. Opele. Okay, the answer is not yes. The answer is no. But I've said it depends. So I expect to hear that it depends, unless it is part of the production process. E.g., like you can see, we are looking at cheese. Cheese will be part of it because cheese has to be stored in a cold place, right? Am I correct? If people in the UK understand what I mean by cheese. Mr. Opele, do you know what I mean by cheese? Yeah, cheese has to be stored in the fridge. Tesco, Asda, Lidl, that's to be stored in the fridge. But if like people in Nigeria would understand what I mean when I talk about PMS, which is fuel, you have to store fuel in the place. So except it is part of the production process, which is important. Like cheese has to be stored in the fridge. Like fuel now is part of the process because for you to say you have even successfully selling a PMS, it has to be stored in a storage center, like what's it called, a depot, and you do throughput on it. So that's when you can say that yes, that it is. So you have to say unless it is part of the process. That is when you can say it is great. So the next question I'm going to be asking is for Mr. Omoefe. Mr. Omoefe, are you in the class, please? I need to answer the next question. Mr. Omoefe, are you in the class? Okay, I'll kick him out when he's ready to join back. Let me take him out of the class. So I know people are in the class here with me. Oh, I didn't know. Ah, sorry. Okay, Mr. Omoefe, the next question is for you. So, when I get to the next question, I'll let you know. So, inventory costing methods. So now I'm going to be talking about the costing of inventory. So I'd like Mr. Amofe to pay attention very well because I'll be asking you a question after this on it. So IS2 allows three methods of inventory costing. I'm going to be opening up my Excel here to do a little Excel thing here. So we have one, the actual unit cost of an item. So you can try to put a thing, you can try to measure using the actual unit cost of an item. For example, if the thing costs some items you're going to buy, you already know the cost after doing all those initial measurements, subsequent measurements, all those stuff. You already know the costs that are included, costs that are not included. I'm going to just do something on Excel quickly to explain that to us. Then now, the actual initial cost, which we know, maybe it's like 50,000 pounds or 10,000 pounds, is the cost of the inventory, is our cost. We can start to measure it in that way by saying, okay, this is our cost, saying, oh, yeah, we're going to do it in this cost mode. Or we can also measure it using what is called the first in, first out, which is what is known as the FIFO method. We have three types in that. We have FIFO, we have what is called the LIFO, and we have what is called the AFCO. Who can tell me how if about LIFO, and if we are allowed to use LIFO or we're not allowed to use LIFO, and tell me reasons behind your answer. Who can answer that question, please? Which countries can use LIFO? There's LIFO, last in first out. Last in first out. Why? Which country can use? Which country can use LIFO? There's UK gap. Okay, US gap. Okay. Thank you very much. Please give her a round of applause. She got it right. So The LIFO, so in according to IFRS, we are allowed to only use. You guys should not be fan. I'll give an end of applause now. According to US GAAP, according to IFRS, you can only use FIFO, first in, first out, right? To measure the costing of your inventory. So you cannot use you cannot use LIFO. LIFO is only used by US GAAP, and I think some other country that uses US GAAP. But according to the IFRS and the UK GAAP, we don't use LIFO. So that's why I'm not bringing LIFO at all. The only thing we use here is just after the initial measurement of our unit cost. The next thing we then do is we either use a FIFO or we use weighted average cost of capital, which is WACC, to do it. Then what the WACC does, I'm going to explain to you because this is I've just written jargon's theory here. Weighted average cost of capital, which applies to each unit. Can you see my screen is shared? Yes, I can see my screen being shared. So I'm going to pull up an Excel now, and I'm going to try and explain something to us using FIFO and and the rest. Can you see my screen? Can you see my screen? Now, let's say inventory. Let's say which company should I use? Should I use shoe or should I use oil and gas? Should I use shoe? Shoe company. Hmm? Then we have um labor, direct labor, right? Labor costs. We have um what's it called? We have give me stuff like give me a name. Leathers costs. Let's say this one cost like 2,000 naira. This cost like let's say 2,000 naira. What other cost again? Nail. Um okay. The policeman has done he has done this thing before very well. What's that? That's that wood. That wood thing. That wood that they used to put to form leg or to form the size. You know that wood. I don't know. Like customized. Well, I don't know. Customized wood. Yeah, mold. Yeah, mold. Then laces. Let's say those things cost like let's say 1,000, and this costs 500. This costs 300. This costs 500. This costs 200. So everything totals this. So so this is the cost of my inventory for this my shoe, right? This is my initial this is my initial what? Um Initial costs, right? Of the inventory. Hmm? So that I've recognized. So this is total for all the shoes I'm making. So now I've used this thing to produce 6 shoes, or let's say 4 shoes. Production for 4 shoes produced, right? 54, 54 that kind of this thing. 4 shoes produced. And I say units. So and I say this divided by 4, right? So I have each unit. So each unit cost is what that, right? Quantity, right? Is what 4. This stupid thing I've done here is what I've successfully tried to explain to you here. The actual unit cost for unique items on that, and the weight is going to measure FIFO first in first out. Let me now measure first in first out. So for example now, when I made this shoe, hmm, I might have made one shoe. Let's say these are the 4 units, right? I made in my stock. In my stock, I don't want to waste time doing a stock table. I understand. I hope you know what a stock table is now. I don't want to waste time. You can go and check it up. I don't want to waste my time doing a stock table on this place. We have the type, We have the quantity. I don't want to start going to do all those things, please. It's a waste of time. Inventory is the simplest thing we can do in IFRS. So then we have, I just want to explain something for you. Then we have 4 shoes. So let's just say we made sander type, then um, quantity, dates produced, costs. I'm just going to say shoe 1. So like that. So I'll say the type is what? The type is going to be what? Sorry. It's going to be what? Sander. How do you spell sander? Is that correct? We have sander. We have slippers. We have what do they call it again? We have what? Please give me type of shoes. Sandals, slippers. We have canvas. Give me one more. Eh? Eh? Give me one more, please. One more shoe. Okay, sneakers. Okay, let me use. Okay, let me. Some of them might be more than one. No, so let's just say sneakers. Open to. Okay, let me use one. Let me use sneakers here. So, and we have 4. Date of production is when? 23rd January 2025, 15th February 2024, 18th February 2025, 10 January 2023. The cost is 1,850. This is sneakers is 2008. Then this is going to be what equals this minus some this, right? To get the figure, 1,850 is open to. If I say 950, 1,750, let's make it on 1,240. So, right, are you clear what I've done now? Is that clear? So now, according to inventory says that when we're using FIFO method, which one are we supposed to sell first in all of this inventory? Let's say, for example, we already have stock before. We have like all the stock we have like 4 year, we have 2 year, we have 3 year. Sorry, I made a mistake. Sorry. We have, yes, I made a mistake in the quantity. So let's assume we have 2, 1, 2, 1. So these ones were produced today. What's today's date? These were produced today, right? While these ones were produced at this date, so I'm going to color them so you can easily understand them. Is that clear? Is that clear? Are we clear with the question? Eh? Eh? We are trying to do inventory according to IFRS. So this inventory, all of these, these ones, were the ones we produced today from the shoe company, right? We produced them today. Produced right today. Is that clear? Eh? Is that clear? These ones are the ones we produce today, which is this 1, 1, 2, 3, 4 at this price, right? We produce them at this price today. So when we produce them today, we have this stock before on ground. We have this this stock was on the 23rd of January 2025. This is on the 15th of February 2024. This is on 24. We've had this stock since those days, which have not been sold completely. So, but this one is the one we produce today. So if I now add them now, we have a total stock of what? Is that clear now? Eh? So now, according to IFRS IS2, when we want to sell using FIFO method, first in, first out, eh? It says the oldest inventory costs recognized first. So which one are we supposed to sell first within these two stocks? Which one are we supposed to sell first? Let's say I want to sell Sanda. I want to sell or I want to sell sneakers. Which one am I supposed to sell first? Am I supposed to sell this one first or this one first? Why? Thank you very much. That is what I've explained by first in, first out. I just use a simple example. Is that clear to everybody? That's the first in, first out. That's what they mean by first in, first out. Because these ones have been there since. Do you get? They came in first. This one just came in last. So the first thing was to leave first before. That's IFRS is saying that this one must leave first before this one leaves. That's just the simple thing that IFRS has said. That's first in, first out. So also there's another method we can use. It's called the weighted average which is weighted average cost of capital. So the other one is when we are applying the weighted average for each one. For example, now let's say we have we want to sell sneakers, right? And I want to sell sneakers. Now look, okay, we have three sneakers. Out of the three sneakers now, because we don't even know which one is. We've produced this sneaker, produced sneakers two before and one before, but then they have variable prices, right? The one we produced before was probably, let's say, 2,750, and this one is. If I've done them in a table like this, if I've done this, let me do something. I hope people understand when I do it now. Equals transpose. I've taught you guys how to use formula, isn't it? So nobody should ask me a question. Do you understand what I've done here? Hmm? Do you get what I've done now? Eh? Yes, I just put them in a different form. So you can see now. So I've brought them in this form now. So you can see them. This is Sanda. This is this. So Sanda, we have one produced, right? We have one produced when. Let me put the date. We produce it in which date? I'm going to reference that date, right? Eh? We have these at different dates. This sander was produced in this date, right? In this date. So now we produce it in this date. Now we want to now sell it. We want to use weighted average to sell them. So don't forget that this we want to sell, let's say, sneakers now. We have two sneakers before, and we have one. So I'm now going to go and check a sneakers book. Under the sneakers book, hmm, under sneakers book, I'll just bring in the ones we have before for 18th. Eh? I'm going to say, let's say 17/02 2025, right? I'll now say to the one for today, which we produce today, right? We know we have three sneakers. Don't forget we have three sneakers, right? We now have the prices of the sneakers, right? I'm going to use round between. So I'm just trying to remind you guys of formula as I'm doing all of these things. Just to remind you of those formulas I've taught you before. Between what? Between 2000 and 29950. So I'm just using random numbers. So you can see that they don't have the same price. So now this is where we now have weighted average. Let's assume we have let's assume they don't have the same reference. So what I'll now do is I'll now say, okay, weighted average for all of this that I want to now use is that okay, since I'm selling sneakers and I want to use the weighted average, I don't because they have different packers, I'll then now say equals sum this, right? Sum of this, right? Divided by what? Sum of what? The quantities of the sneakers. Hmm? Is that correct? Then the weighted average price is 2675. That's the way to also get the price of the quantity of the item. I don't know if that makes sense. Does that make sense? Hmm? If I come here and put 2675 now, and I do it like this, Control Enter. Sorry, 2675. Sorry, I'm just to show you my formula. 275, Control Enter, and I do sum it to give me the same figure with that. Do you see it? Hmm? Am I moving too fast or you guys don't understand what I'm doing? Eh? It's equal to every other person. So I'm just trying to prove to you, like I could show you this thing in one of my inventory I do in my clients, but you will not understand it. Do you get? If I show you a big inventory spreadsheet that I have that has this thing weighted average, you will not understand that they're just going to be big ground, but you've paid to come to class because you want to understand that I'm giving you the simplest way as a child. This is what weighted average is all about. In fact, when they taught me when I was in ICANN, I did not know it then because they taught me in a bogus way. But this is what it's all about. Sometimes you use formula to do it, though. Don't forget, you use the whack to do it, right? You get cost of capital, all those things. You get a this a factor of let's say three in one rubbish thing like that. So it depends. Those ones are for like larger stuff, not for this small one. Do you get? So they tell you should use this. So, but basically, what you're doing is just to get the average price of it. That's weighted average, basically just to get the average price of it. Sometimes you have to use like all those the rate and all of those things to do them. So I don't know if that is clear if you understand FIFO and then weighted average cost of capital. Is that clear? I'll still give examples more to make it clearer. Please let me know if I should move on or not. Are we all clear? Mr. Omoife, are you clear? Miss Sandra, are you clear? This you can move on. You people say it's like people don't understand it too. Eh? Okay. Mr. Omoife, do you understand it? I'm moving on. So subsequent measurements. Inventory is now measured at lower of cost subsequently after you've gotten the cost of inventory. So now you've gotten the cost of inventory. Using weighted average, we got this as weighted average, right? Using our work. Eh? Using weighted average. What am I doing now? Using a weighted average, we got this, right? Using our initial cost, we got this. Don't forget, right? Is that correct? For that item, for like these ones which we produce, we got that for initial cost. Then if we use individual cost, we get all of these costs individually for them. Now we've gotten that. Then now that we've gotten this, we now want to say subsequently, that is for the first year, right? Year one. Let me use just one product. Let me not use more than one product so I don't confuse you. Let me use one product. Year one. Year one. Our inventory is what? 8,025, right? For sneakers. Year one. I'm just gonna use sneakers alone for now. The total inventory for sneakers is 8,025, right? Then while the quantity is how many? Is three. Quantity is three, right? Then the unit price is what? Price using weighted average, right? Eh? Is what? 2675. But if you are using this thing, it has variable prices if you are not using weighted average. So let's assume I've adopted to use weighted average. So this is year one. That's the initial recognition. That's what it is called. Initial recognition, right? This is year one. Initial recognition. Then subsequent recognition, which will be year two. Subsequent measurements. IAS 2 says that we have to recognize inventory at what? At lower of cost and net realizable value, NRV. What this means is that NRV means the estimated selling price of the goods. That item you have in your shop might not have that value in your shop. So you have to do an assessment. You can see it says assessment must be done line by line. If I show you an inventory I assess, guys, this thing that they said it has to be done line by line. Inventory has to be assessed line by line. You must not miss any line. I used to assess inventory of up to 1,000 page. You assess it line by line using formula to make it faster. That's the best way to assess inventory. So grouping if permitted, if they are similar item, you can group them. Let's say you see bonnet, you see rod, you see something, but they all form one single car, then group them to form the car, and then group them as one inventory as a car. Does that make sense? So now, if you're not saying it has to be measured using lower of costs and net realizable value, I'm not going to explain that to you. So now, when we say lower of cost, this is the cost at initial requirement is 2675. Then now we now want to look at that this thing that the following year, these same sneakers, eh, that the quantity that we have for this, and we have three quantity. The way to now recognize is to say that has this inventory be sold at all in the year? You get, for you to know what is called the NRV, the net realizable value of that inventory, which is same thing as you want to know the carrying amount of the inventory. Sorry, not the carrying amount. Sorry, you want to know the fair value, of the inventory. We want to know what the fair value is and not just the carrying, because what we have here is the carrying amount now, which has come to the second year. We want to know what the fair value of that inventory is. That what is the real measurement of that inventory. We now have to measure at net realizable value at lower of the cost or net realizable. So now what we have as the cost is what 2675. Initially, that we measured is 2675. Now, what is the amount you can realize on this inventory today? How do we know? If Taupele wants to buy this sneakers from me, and he says, this sneakers too cost to, okay? This sneakers is no more than 2,200 pounds, so 2,200 naira. Oh. I can't buy this sneaker for 267 for what now? Then I now will take step to go out the market and go and check that how much are they selling? How much does inventory? How much does what's it called? Does sneakers cost? So let me speak as an auditor. Auditor, this is how I would do it. If I want to know the net realizable value of an inventory, what I would do is basically this. Sorry, have I put something there? So as an auditor, this is what I'm going to do. I'll just go and say, I'll say sales. I want to look for the closest sales you've made for the inventory. So if you sold this inventory for this is the cost, right? And you say you put one piece, you say you put 20% margin markup on your inventory. So because you need to know the sales price to get your markup. I see, are you guys with me? I'm being practical here. I don't want us to be doing textbook. Okay? If I teach you in line with textbook, you will know textbook, but you not know it, and you not even know what you are even really doing. So practically, what it is obtainable everywhere is when you want to know the NROV of an inventory. You say equals what is the selling price? The company says that okay, our this is our inventory at cost, right? Our selling prices, we always have our policies that we always have what? Policy of what? Of 20% markup, right? Eh? On what? On cost of all inventory, right? So thank you very much. I'll then come and say what? I'll say this times what? 1.2. Am I correct? That's supposed to be my selling price. Is somebody with me initially? That's supposed to be my selling price initially for that inventory. Now I will now check as an auditor or as someone who wants to know the net realizable value of the inventory. Has any of this inventory been sold at all in the year? That's going to be my question. Now, sales in the year, actual sales made zero in the year. I start thinking zero, and I ask management question, why is there zero? Oh yeah, the inventories are specialized products. So there are reasons. I don't want to load you too much now. There are reasons why inventory might not be sold in a year. It doesn't mean that the inventory is bad. I hope you believe me. Do you agree or not? There are reasons why inventory might not be sold. I mean, are you with me? Sandra, are you with me? There's a reason why there are reasons why inventory might not be sold. Who can tell me why inventory might not be sold in a year, and then it doesn't mean that the inventory is obsolete or there is issue with net realizable value. There might not be impairment on inventory. Who can tell me why? For example, this kind of inventory now, Sandra, these sneakers now. I made sneakers. I have sneakers in 2020, let's say 2024, hmm, February, but I've not sold anyone up until now. This is total price of the sneakers 2024. What is the reason that my cost is for it not to be sold and it is not impaired, but it's just not sold? What other reason can it be? Okay, but I do not agree. I don't agree. Who else want to answer? Then if it is out of use, I don't agree. If it's out of use, then it is impaired. My question was that without it being impaired, that which means it is not sold, but then there is no impairment. There's no element of impairment. That's my question. So you have answered it in line with impairment. That if it's out of use, yes, then it means it's impaired. It means we know the product is impaired. I'm not. Do you want to try? Okay, they are odding, right? Is that what you mean? Okay, there's a possibility of that. Possibly, yes. I didn't even think about that. Yes, they might be urging it because people do it a lot, especially in like in the energy, like Mr. Emma said, in the energy industry. Some people might try to keep from fuel PMS in this depot. They will not sell it because they know that if they sell it, the price would go up later. They can try to or that is one reason. Second reason is if the item is a specialized product. The specialized product whereby, for example, the part of a plane that rarely gets spoiled, eh? Or the part of a airpiece plane, which it is customized and made for airpiece plane alone, then it means I cannot sell that same flight. I cannot sell that same part of British Airways. I cannot sell that same part to Virgin Atlantic because it will not work for them. So if it's a specialized part, then it's not impaired, but it's not just being sold because our customers have not ordered. I'm saying this because I have a client. Let me pause the video. So special products are always like that. So they will remain like that, but they will not be impaired. So, however, in this case, let's go back to the case of this scenario now. In this case now, if this sneakers now has not been sold in the year, right? I will now pause and think, no actual sales made, and they said the sales is 3,210. Then what I will now do is I will now go and check that what is the price of sneakers outside in a similar company. Don't forget when you did IFRS 13 fair value, they use what is called observable markets. Option two, level two, right? That level two observable market is what I'm now going to now do. I'll now go on internet and go and check on internet. How much does Amazon sell sneakers? If I see that sneakers price is sold for 3,150 naira, but in Amazon, I will not say this product is impaired because the price is close to this price. Is that correct? If Amazon sells sneakers for 3,070 naira, I will still not say it's impaired because the price is close to it. However, I will note it down that it's a bit lower than, it's a bit higher than what the market price is. But however, it's not matter because it's not really impaired. But if Amazon is selling sneakers for 2,700, then there's a problem. I know it's impaired. Do you know why? Because you have produced this product for 2,675 and you say you're selling for 3,010, which means Amazon is even selling this product for the exact price you produced your product, which means there's an impairment on this item. Does that make sense? Does that make sense? Then which means that the net realizable value for this asset now is 27. And when it's 27, I'll now come and say, okay, NRV is what? NRV is what? NRV is 27. Then what does IAS 2 says? IAS 2 says that what? It says lower of what? Lower of what costs, right? And net realizable value. Now, what is our cost? Our cost is what? Our cost is what? 2675. What is our net realizable value? NRV is what? 2700, right? Divided by zero point 0.8. Sorry, divided by zero point 0.2. Sorry, I'm busy now. What am I doing? Multiplied by, right? I'm supposed to do this multiplied by zero point 0.8, right? So you know what I've tried to do there? I've tried to take off 20%, right? Because they say they are markup 20%, right? On this. So in a similar market, I've gotten that it is lower. So therefore, I'm going to be valuing that inventory at what? So which one is lower in these two now? 2-1. So this is the value. So I'm not going to that come. Subsequently, I now measure it at what? The unit price will now be what? 2,160. It will no longer be what 2007 this thing again. This subsequent measurement because there's been an impairment. So this is the fair value, hmm, based on net realizable value, which is the amount you can sell this stock today and then make money from it is 2160. Do you get? So what we then do is I will do what you usually debit your expense. You debit what P&L, right? And then you credit what tell me why am I crediting? Accounting entry, guys. Thank you very much. Does that make sense? What I've done? Yes, please, with the difference. Sorry. Yes, with the difference. I mean, I thank you. This minus this. Then what you will not call it worked. My clients are fond of doing this very well. They are a guy in doing it. So in Nigeria, they don't do this in Nigeria because the people in Nigeria don't know what is wrong with them when they do their inventory. But I'm telling you, I don't know what's wrong with them. But over here, I can assure you, if I open any GL for you now, you'll be seeing stock difference will be about 5,000 page stock difference. They check their yes, you just see stock difference. Stock difference. So when you are doing it, will be an expense code. So when you are doing your GL, when you are doing like expense testing as an auditor, you'll be seeing stock difference, plenty stock differences. So you can easily trace them back, but I don't have time to trace them back. I only pick the big ones. You can see stock difference of about 1 million, 1.5 million stock difference. I pick those ones and I audit them. I test them. I test them back to the stock, back to calculation, and back to audit to be sure that there's actually a difference. But the ones that are like 50,000 pounds, I don't care about those ones. I don't check them. 50,000 pounds. I don't check those ones. So that is it. That is it. I don't know. Is it clear? I've just showed you. So how I'll do when I get to audit, I'll show you in audit. Don't worry, we're still going to audit. Don't worry. Let's not move before we get to audit. When we get to audit is my house. So I'll calm down. Exactly. I'll calm down in audit. Don't worry. So I don't know, Sandra, is it clear? Mr. Upele, is it clear? Miss Sandra, is it clear? Miss Aminat, is it clear? Okay, Mr. Amoefe, is it clear? Madam Sandra, is it okay? Is that clear? She's not responding. Okay. Okay. All right, man. All right. Thank you. So that is the explanation I've just. I just don't want to do. I don't want to do textbook, and be talking without showing you practical. I just sort of. I didn't plan this before. I was sort of showing you practical. So now, how to determine NRV? I've even got to determine before you determine. See, exactly. So contracts provide strong evidence. You see, how to determine NRV. So look at contracts. You can say I talked about it that you can look at if there's a. You can say I talked about that there's a contract for that vehicle that produces that bonnet. You get. You remember I said so. There is a contract for that vehicle that produced bonnet in Newcastle that they had the contract that the price that they will keep buying from them. So therefore, I know that it is a strong that there is no impairment because that contract is going to be fulfilled. But if I'm buying social product for to sell to you, and I'm 100% sure that nothing will happen. If you don't buy them, we're going to sue you. The company will sue you. So therefore, I'm sure that you no issue with impairment. Raw materials not written down if finished goods will be profitable. You can see if any good will be profitable, you don't need to write raw material down, which is clear. These are very clear because you know that you are going to use them for finished goods. So you don't need to write down raw materials because they're raw materials. So you don't need to be saying you're testing the payment on them or NRV on them because you are sure that if finished goods will be profitable. So why are you bothered about raw materials? So then also decline in raw material price may reduce NRV also. If the raw material price goes down, let's say for example you bought that leather for 2,000 naira yesterday. Today it becomes 1,000 naira. Then you know you want to sell at 2,000 naira and your product will be high. But if you go and do a market survey and check out whether it is 1,000 naira today, then there's going to be a problem. You can't sell at that price again. So that's going to be an issue for your product. So replacement cost is also evident. So example of NRV written that say inventory cost equals $100. NRV is $80. This is how you see. I see now I give you now. I've given you it now. Because I did not go down and explain to you how I obtained NRV. I only just put $80, but now I've come here to explain NRV to you in a more practical sense. Because in textbook, what you'll be saying is this NRV. How did they get NRV? You don't know. You've seen NRV, $80, carrying amount, $80. How do you know carrying amount? It's like people who come out of school, finish the exam, pass the exam, and they don't even know how to determine NRV because they've never done what they've been saying in the exam is NRV $80. NRV this carrying amount. How do you get carrying amount? How do we determine it? Do you get? That's how I've showed you how to determine those things. You get now. So inventory cost is $100. NRV is $80. Carrying amount is what? $80. You know why? Because it is lower of cost and net realizable what value. What is the net realizable value here is $80, right? So the cost seems to be higher than NRV. So therefore, our carrying amount of our value of inventory the following year will be what $80, just as I've done here. Our carrying amount in subsequent year, can you see subsequent measurement is what 2160. We did not recognize it again. We now put this to loss. So what have I done here? I've done credits. So I'll just do the same thing like this. So I'll say 515, right? I'll say equals this minus 515, right? I've created inventory like that, right? And I have 216. I'll now say stock difference, inventory. This is what I've created. Then debit to P&L. Just that I've done to show that. Because that is my okay, I get yeah, because I didn't do that. Yeah, that's true. Times two, thank you. Times quantity, right? So it becomes 6-4. Can you see? So thanks for even reminding me. I'm not. So remember, we have to post everything to account to the ledger, right? Hmm? Multiply by three, isn't it? We missed that. Thank you, Mr. Opele, for reminding me that we missed post or the posting. So this is the loss we made. So this is what we go to because we have three sneakers quantities. So this is not the carrying amount. So this is the carrying amount hmm, of the assets. Yes, which is the net value. Yes, because the inventory cost to carry the formula is carrying amount. That's the formula. Carrying amount equals what? Equals NRV minus costs minus what? NRV minus lower of NRV and costs. That's the NR. That's carrying amount. So NRV, which one is lower? NRV and cost, which one is lower? NRV seems to be lower. This is NRV. This is cost. So that is why we have it there. Is that clear? When we did it initially, we got a cost of our stock of 2675. That's the cost, right? Yes. Then when we now remeasured it in the second year, because I was also check our inventory for impairment, we discovered that the NRV, the net realizable value, which we can buy the product now in the market, is what 2160. That's our NRV. So which one is lower within the cost and the NRV? Which is lower? Is it not the NRV? I said that it is so we want to get our carrying amount. These are our carrying amounts which we want to get, which we don't know yet. Hmm? Right? We don't know our carrying amount yet, right? Assuming this is blank, we don't know it yet. That will be blank. Can you see? So we don't know it yet. So now to know our carrying amount. The carrying amount is what lower of what costs and NRV, right? The lower cost and NRV is now which one? This is the lower of it. So therefore, we pick this. If the carrying amount was, let's assume the carrying amount was, let's say it was let's say 3,000. Let's say the NRV was 3,000. Eh? If NRV was 3,000, what would be our carrying amount? Lower of cost and NRV, which one is the lower? So the cost will now become what? So it will become what? It will become the same thing. Do you get? Eh? Do you understand what I've done now? So it is lower of it. So whichever is lower is what we pick. So if the cost is 2675 and the the fair value, which is the NRV, becomes higher, you still pick the costs and they put it there. Do you get? You don't revalue it higher. But if the cost becomes lower, it becomes higher, and the NRV becomes lower, then you have to what pick what the NRV, which is the lower. Do you get? No. Look at the formula. And IAS 2 says what? That we should value inventory by what? If say value inventory at lower of cost and net realizable value, that an IAS 2 say, it did not say higher. So we are looking at lower of cost and NRV and net realizable value. So what is the cost here? Is 2675 is the cost. Let me put it here. Cost 2675. NRV 2160. So which one is the lower from them? NRV is lower. So therefore there's an impairment because it's lower than our cost. Do you get? So therefore we have to recognize impairment loss and then post to stock loss difference account. Do you get? But if NRV was higher, if NRV was, let's say NRV was 3,560, and then the cost is this, what would we do? What would we pick if the cost is for an NRV was higher? What would we do? What the formula? Lower of NRV and cost. Which one is lower here in these two? We pick the cost because the cost is lower. The formula says lower of NRV and cost. So it is lower we go for. Do you get? Either way, we go for lower. So yeah, now this is the lower, we go for the lower and we use it. Yeah, now this is the lower, we go for the lower and use. So if this is the case, we just restate this back as the normal BC. We don't go to use the higher one. I hope that solves your problem. No, we won't. Yes, yes. NRV is lower. Yes, yes. It just go to, yes, you just go to stock P&L as a debit in P&L. All right. So disclosure requirement: entities must disclose what total carried amounts by category, inventories carried at NRV, expense recognized for inventory written down. You can see written down inventory, circumstances leading to write down reversals. In fact, I can tell you guys, inventory in the UK is difficult to as well. May you not face some kind of very very difficult complaints on inventory. They use different kind of stupid inventory recognition. They even determine the this thing is difficult sef. I just want to show us some examples. If I bring up an inventory file now to show you inventory file, you see the way what I read now is what is making me saying this, because they say recognize, express recognize for inventories written down. I've seen inventories that are written down, that they write inventory down, they make provision for inventory, provision made for inventory write down, and then a lot of nonsense like that. And then reversing back to inventory again when the inventory went up back again, and all of this nonsense. But it's well. Let's go to questions and answer now. Now, time for me to sit down and listen to you guys. Answer for me. Oh, yeah, Aminat, over to you. This question. You can read out, please, and answer. The next one is going to be Madam Sandra. So please be ready. Okay, so I'm gonna answer me. Answer us, what's the cost of the inventory? Yeah, I'm waiting now. Can we move fast, please? This is a very cheap one now. I shouldn't be giving you this one. Yes. You said what? You said what? I think you are correct. Yes, you are correct. Because the purchase price £50,000, then import duty is £2,000, then transport cost is £1,000. Then don't forget the VAT is refundable, so it is excluded. Okay, we don't put discounts. You remember I talked about discount before in inventory, so that's correct. So the next one is Madam Sandra. Over to you, ma. Madam Sandra, over to you. Can you read the question, please? Yes, I can hear you. It's there now. There, it's there. The question is on the screen now. Every other person can you see it? Another seat. Okay, okay, okay. 30,000. No, it's not because it's a very simple question. Just give it a try, give it a shot. It's simple. Break it down. It's very simple. Very, very simple question. It's not up to exam standard. The next person is Mr. Moefe, be prepared. After that one, I did Joke, she's just running off, coming in, running off, coming in. It says network like that now. Deceiving yourself there. You're just running out, running in, running out, running in. It says network. Hmm. Let's see if what you said is right. Let's give Sandra a round of applause. Sandra has seen my answer before. Thank you, Sandra. Let's give her a round of applause. Why you beat people beefing now? Give her a round of applause now. Mr. Moife, be prepared. You are next. So now you consider direct material cost, direct labor costs, and variable value, which is about what 60,000. Then fixed overhead cost is going to be allocated at what at capacity of 10,000. So you have to do 15,000 divided by how did Sandra get this thing easily? So 15,000 divided by 10,000, which will give 1.5 per unit, then times 8,000 will give you 12,000. Then if you add that up, you will then get what 72,000. So each unit, the unit will now be what? The cost per unit is going to be what? It's going to be £9 per unit. So although you didn't finish the question completely, but at least you got 90% of the question. Do you get? So because the capacity is 8,000, I don't know. Does everybody understand this question? It's a fixed overhead expense that was broken. That yes, and because there will be that overhead that you said that was allocated of 3,000. Where is it? Or 15,000? Eh, is a cost that involves so many things. It will be usually overhead for head office cost. It will be part of it because it is overhead that let's say there's some other costs that are involved, like let's say rent. Do you get rent of office? This one, that one. Those costs I cannot you cannot easily pick out one by one. Office rent, let's say you produce use paper to write some of the cost material. You did some things that you cannot easily bring out. So that's the cost of 15,000. So that's the one because now they did not produce, but if you look at that direct labor cost, you cannot break it down because labor hours is 20,000 or 20,000. Variable overhead there, which is contract staff, people that are coming, Amazon shifts people and all those things, 10,000. Direct material labor, 30,000. That is 60,000 constant. Then that 15,000 is what you now have to do what? That's what you now have to do. You have to now divide it by what? 10,000. Then to get the 1.5, then multiply by 8,000, which is capacity you produce, because that overhead cost is fixed. You cannot take that all overhead cost 15,000 because it is a fixed cost on variable things that were done. So therefore, since we didn't produce 10,000, we have to take only 8,000 from it. Do you get 8,000 units of it and remove the 2,000 because that's the waste in it because it's an abnormal cost. Do you get? So that is the 3,000 abnormal loss of the fixed overhead cost, which is taken off, not included. I don't know if you get what I mean. I explained this abnormal cost before here. So, Mr. Upele, Mr. Moife, over to you. Mr. Moife, over to you. Simple question. Go on. sir. Don't go silent on me, oh, Mr. Moefe. Mr. Moefe, are you there? Hello, Mr. Moefe. No, let me kick him out now since he's not there. Um, okay, I've kicked him out. When he's ready to join, he will join back. Some people might just be there, they'll just form as if they did not hear because they don't want to answer question. So, Mr. Opele, over to you. What's it? Thank you very much. That was correct. So those costs should not be included in the cost of inventory. So no, all are excluded and charged to P&L in the period occurred. So they are not to be included. You are correct. So I want to ask you the next question, Mr. Opele, because this question is too cheap for you. So no. This question I'm going to ask Aminat. Aminat, go on. This question for you. All right. Oh yeah, Aminat. So complete the closing stock using FIFO and AFCO. Okay. So using FIFO, first in, first out. So if you look at it, we first add in January, which we start from January, right? We have 100. This is plus 150 plus 150 at £12. Mm, wait, 100 at £10. 150 at £12 equals 1,000 plus. No, no, I must have made a mistake there by putting 150 there. 100 at £10, yes, then 200 at £12. That should be what it should be. Should be 200 at £12. That was a mistake there. That's 1,000 plus 1 8. Anyway, that's 2 8. Then the closing stock will now be, I'm coming, sorry, 300. Oh yeah, yeah, that's correct. That's correct. What I did is correct. It's correct. It's correct. Because it's going to be what? Don't forget we are doing what? FIFO, right? First in, first out. Don't forget. Is it clear to everybody? So January stock is what? 100 at £10, right? We then have what's it called? We have 200 at what? £12. We have 100 again. And so we then sold what? We sold 250 in the year. Or 250 we sold in the year. Well, normally we have 400, right? Is that clear? Hello, can you hello? So should I go on? So should I move to AFCO now? So you know how it is assigned, right? Okay. All right. So then AFCO, like I said, it's going to be based on the weight. 100 times 10 plus 200 times 12, right? then plus 100 times 14, right? Divided by what? Total units, which is 400, right? Is the total unit, right? To get the average. And the average is 4,800. Then if you divide, then that will give you, sorry, total 4,800 divided by 4, that will give you 12. That will give you the 12 pounds. So that 12 pounds, now you've already sold that many, you sold 250. But therefore, you're going to be having 150 times 12 pounds, which is equals to 1,008. Simple chicken now. That's average. You can see it's very simple. It's exactly the example I gave you in my Excel. Hmm? You can see it's exactly the example I gave you. Average. Eh? Exactly the example I gave you. Divided by this. So that is that. So are you guys enjoying this inventory now? The next one, Madam Sandra. No, Mr. Wopel answer this one. Yeah, Mr. Wopel answer this one. Very easy. What's the carrying amount? I just taught you now. Inventory cost is 50,000. Selling price is 52,000. Selling cost is 5,000. Why do you say what would you call it? Say 10,000 as the carrying amount. Why do you say that? It's 47,000 now. Do Have you forgotten the rule I gave you about NRV? Ah, inventory cost 50,000. That is the initial cost of the inventory. Subsequent measurement is the expected selling price. You learn that the expected selling price 52,000. The selling cost of that inventory is 5,000. So if you take selling cost away from from the expected selling price, you get 47,000. Which one is lower? 47,000 is and is the NRV. The inventory cost is 50,000. Which one is lower? Which is 47 and 52,000 and 50,000. Which one is lower? Eh? 47 and 50,000, which one is lower? 47,000 and 50,000. Exactly. So the lower, we said the lower of cost and NRV. So with the lower is what we are picking. So therefore, there's an impairment of what? 3,000. That's what it means. So 2,000 minus 5,000, which is selling cost 47,000. Lower of cost 50,000 and NRV for 7,000. Write down 3,000 as expense, which is the impairment. Okay, now nothing more. Next one, Madam Sandra, over to you, ma. Madam Sandra. Like Madam Sandra is in space before like when you click to unmute before you come and click to unmute before you come says like it takes like when you're in mass and some people are just saying you are close to Elon Musk. Raw materials cost 5,000. Finished goods, that means when you're using them, expected to sell at a loss. Should raw material be written down? You don't even need to do the answer is just there. The answer is already there already. Correct. Because they said raw material cost is 5,000. Eh? But the finished goods which you use that raw material to get, when you use the raw material, the finished goods will be expected to sell at a loss. So therefore, the raw material is already expensive. That's what it means. It's higher than the price. So therefore, it should be written down. So since finished goods will not be profitable, raw material should be written down to replacement cost, evidence of NRV. Exactly. So next one, Mr. Opele, answer this one. So what disclosure must be made under IAS 2? Oh, Pele, well done. No, be using ChatGPT. I can see you typing. Now I muted it. So now you're what you're typing. Thank you very much. Let me put the answer here. Don't worry. I've already put the answer here, so you don't bother yourself. Because I already said that you're typing. You're not quickly muted. I'm just being inquisitive. I'm an auditor, so I have a question in mind. I at 200. Okay, I'm just using as at 200, which said we should have question in mind. So I'm having a question in mind. So I brought the answer. So the things we should disclose should be carrying amounts by category, raw material, work in progress, or finished good. We need to disclose it. Like you can see, a proper inventory would have raw material, WIP, finished goods. Then amount carried at NRV, the amount you are carrying them at the net realizable value, which is subsequent recognition. Expense recognized for inventory write down. It will be in the P&L at the last page of the account at the back. Then reversal of write downs and reasons. Cost of inventories recognized as expense in cost of goods sold. And that's your disclosure you need to do in the account. Oh, okay, yeah, 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 yeah. Yeah, so you say for example now when you are getting disclosure, you say already when you are presenting you have presented your inventory by saying raw material, below it will not be WIP, below it will not be finished goods. You get or finished goods might come first, and you want to do it. Then you put their front figures in front of them. Then in the at the last part of the balance of the account, the last page of the account always have the P&L breakdown of expense. You have cost of sales breakdown. You have expense, admin expense, so in that part you'll have seen inventories. You'll have seen like things. It might be lumped up. You might just see cost of goods. You might just see 50 million expense there. But however, if you now go, but because it's not on the account, because it will be in your schedule somewhere, you understand, which has those reversal. And so in the notes to the account, you don't have to explain in the notes saying that inventory write down in the year amounted to 25 million as a result of prudency by management, realizing that the inventories were not carried, the value, were not representing fair value. And IS2 states that, you understand, you will say that, you might not even say IS2, you will say IS2, you just say that, um, you say that you say there's a word that you want to use, like maybe like I don't want to mention IFRS, but if something states that the way it is being framed, that the way we frame it states that inventory should be carried at lower of cost and net realizable value. So in this consideration, we decided that the net realizable value of these inventories, to them to depict the net realizable value of these inventories, then we had to write down inventory worth to a tune of so amount. Also, during the year, some inventories that were previously written down were reversed. Inventory you reversed in the year will not be written in your disclosure. Do you know? In the year will not come in your disclosure because obviously they happen in the year. It's inventory that you've written down in the previous year and you're now reversing. That's one that will come in because it does not make sense to be writing disclosure for inventory that you've written down in the same year because it's something that you journal and finish up. Do you get? Exactly. Yeah, exactly. Yes. Because yes, that's why I talking about 25 million. Yes, exactly. Yes. In a year. Yeah. Yeah. So that brings us to the end of this class. I'm supposed to take us another class which is called IS 37, but I'm not sure if I can continue. I'm getting tired already. Yes. I say I'm tired. I'm telling you I'm tired. I'm tired. Can we do some other time during the week, like one day during the week? I feel like I need to catch up. I'm behind. Like I'll just do 45 minutes to take off I 37, please. Yeah.